You're listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone, from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing,
I'm Deidre Woolard, an editor at Millionacres, and thank you so much for tuning in to the Millionacres Podcast. If you haven't noticed, we're in the middle of a single-family rental boom. Not only is this home sales market highly elevated with record prices and kind of a slow trickle of inventory, but the demand for single-family rentals is just spiking like crazy. A lot of big companies are taking larger and larger shares of the portfolio, throwing more and more money out there. We're going to talk about all of that today with someone who's dedicated his life to making investing in property simpler. Who doesn't love that? Honored to be chatting today with Gary Beasley, who's the CEO and co-founder of Roofstock. Gary's the driving force behind Roofstock's goal to power the future of real estate investing. He led two companies through IPOs, Zip Realty as CFO and Starwood Waypoint Residential Trust, which is now part of Invitation Homes, which is the largest single-family rental home REIT in the U.S. And he was a co-CEO there. So Gary truly understands this space. So thank you so much for joining us today.
Great to be here, Deidre. Thanks.
Well, let's talk about this single-family rental boom. It's dominating the news. Investors are wondering what to think. Some of them are afraid they're going to get squeezed out. What do you make of some of these recent moves that big companies like Blackstone are making to acquire large single-family rental portfolios?
Well, it's interesting. It's been going on for quite some time, actually. Blackstone was one of the earliest groups, as you recall. They were the first money behind Invitation Homes. They really started buying in earnest around 2011, 2012. So this is kind of a new foray. They recently purchased Home Partners of America, a really good large operator. So I would say COVID has been an accelerant to this trend. And you're seeing many more groups beyond the ones who had initially invested or had gotten comfortable with the asset class now getting comfortable with it. And I think for a number of reasons, it's been validated now in the public markets for a decade. You have now track records of lots of quality operators proving this is an asset class that could be operated profitably at scale. And I think the other thing is housing has proven to be incredibly resilient throughout this COVID period, where rents and home prices have continued to grow, and so the properties have performed quite well, and in fact much better than almost all the other real estate flavors, if you will. So when you combine really solid performance, resiliency, it's also the largest asset class in the United States, U.S. housing. It's arguably the largest asset class in the world if you look at the 25 trillion of homes out there. So, and up until about a decade ago, investors couldn't really get access to it. As you think about it, it just wasn't an asset class that was available. So it was all mom and pop investors. Now it's still only about 2% institutionally owned, and that's something we can talk about. So there's a lot of dynamics going on there. But I think when you look at the supply demand dynamics, the fact that there's good yield associated with owning these homes, and the performance and the resiliency, I could see why it's attracted more and more attention.
Let's talk a little bit about that 2%, because there's been a lot of discussion, too, about what's happening when a community has a large amount of corporately owned rentals. Is it squeezing out smaller landlords? Is it changing the flavor of communities? What do you think about that?
I get it. It's an interesting, and I would say it's a nuanced discussion. There's no obvious answer there, and I think it depends. I would say it's a good analog I think, is to look at what happened during the last financial crisis. A lot of professional capital, institutional capital came into the market in 2012. That provided a bottom to the housing market. And there were millions of homes that had been foreclosed on that needed capital. And the capital wasn't coming from the public sector, needed to come from the private sector. And so when you look back, I would say that institutional capital kind of saved the housing market, and everyone's equity in the existing home stock went up. And it's been going up every quarter since then, since January of 2012. So there are benefits to this institutional ownership. Now, I guess the other thing I would say in the argument of the benefits, there's a lot of capital that could renovate homes and provide good service. So if you have a landlord who will fix stuff when it's broken, that's good. If you have a landlord who has a reputation to preserve and a brand to preserve and has 24/7 maintenance, and you get stuff fixed, that's good. If you get your security deposit back, that's good. This stuff doesn't always happen in the rental industry. So that being said, corporate landlords need to be responsible and need to be cognizant that there's members of they're members of the community. And I think what you'll find is, for the most part, the larger owners have been really good actors. In fact, during COVID, even in places where there were not restrictions on evictions, they did not evict people, worked with folks on payment plans, and really kind of helped get through that. So I think it was a good example of I think a lot of the larger owners doing things above and beyond what they needed to do. So I think that was a good sign. It is a big market. I think there are some sub-markets where there's been a lot of institutional investment where you can argue that there's been, perhaps some challenges for people trying to buy homes. But for the most part, there's 5 or 6 million transactions a year. Investor transactions tend to be about 20% of those. So 80% are, average Joes buying properties, individuals buying properties, and that's been the case for a long time.
Well, you mentioned a couple things there that I want to dive into. The first is that we have had those price increases since January 2012, which I think has a lot of people talking about, are we in a bubble? Are we not in a bubble? Certainly, I'm team no bubble, but I think that there's also a point here with the corporately owned rentals is that if we have another situation where there's a flood of inventory, there are more stopgaps in the market now. What do you think about this? Are we in a bubble? Are you thinking about that?
I guess I've never called myself team no bubble, but I think I'm in team no bubble with you, Deidre. Listen, I studied economics, and I do feel this is a classic reflection of the supply-demand dynamics in the market. And the last downturn, the Great Recession, was a credit-driven bubble, and you didn't have people with a lot of equity in their homes. It was all debt financed, and people were borrowing over 100% of the value of properties to buy them, and you could sort of see it coming. Here, I think you have, over the last decade, an undersupply of homes relative to the amount of the demand for homes. And so for lots of reasons, we could talk about why that is. It's restrictions on development, it's lack of land, it's costs of labor, costs of materials. All these things continue to constrict the ability to build homes. It's a lot easier to build apartments. You can go vertical. It's hard to build homes. Yet you have real demand for people to want those homes. And so I think it's a classic reflection of supply and demand. And because of that, I think you'll see more gradual changes in pricing. I don't see an event that could change it too dramatically. There's always the black swan event. What if interest rates go up 300%, 300 basis points? I don't see how that's going to happen. But those kinds of shocks to the system could create kind of a seizing up. But I think absent something like that, which I don't think is likely, I think you will see home price appreciation cooling, lowering. I don't think you'll see 12, 14% a year. It's not sustainable. I know you won't see that over the long term, but if it gets back down to 4 or 5%, how does that feel? If rents are growing, yields stay pretty consistent. So I don't see the makings of a bubble. Not always right, of course, but that, if I were a betting person, I'd be part of your team. No bubble.
Another thing that you mentioned before was about the eviction moratoriums. The CDC just extended. We keep seeing, individual states going through things. Everybody seems to have a different take right now. How did that whole situation impact Roofstock?
It was amazing, Deidre. I was shocked by how little there was in the way of non-payment of rent and issues related to that. Throughout the whole COVID period. I really thought when we were sitting back in April or May of last year, there would be an awful lot of problems. And it was, I think, a combination of landlords acting responsibly, both both mom and pop and institutional landlords viewing this as sort of a national crisis, and let's sort of get this through together, and stimulus, right? So you had an enormous amount of government stimulus coming in. Now, it wasn't perfect and all that kind of stuff, but there's a lot of money sloshing around, and it got to a lot of people and helped them pay their rents. We had some help on the landlord side and the overall ownership side. People being able to defer their mortgage payments if they had any issues. All those things together, along with the sort of collaborative mindset, allowed us in general, not that there aren't individual examples of problems, but for the most part, got through it pretty well. And now we're coming. So when we look at the collections and the vacancy of our portfolio, it stayed pretty solid. It might have varied a couple percentage points throughout that, but it didn't go from 98% to 80 or something like that, which people thought could happen. It stayed in the mid to high 90s.
Let's talk about build to rent, because I feel like that's becoming more of a conversation about single family rentals. And Roofstock, you're kind of ahead of that with your partnership with Lennar. Can you explain how that works?
Sure. Well, first of all, build to rent, a few years ago, nobody thought it was going to catch on. It just it was a niche. People are like, how many homes could be built? Turns out a lot, because when you get big home builders like Lennar and others who can look at the build to rent channel as another great channel to sell homes, it's starting to allow them to create more and more supply for the market. And I think for investors, it's probably the easiest flavor of single family rentals for new investors to get comfortable with, because it feels institutional. The product's new. International investors like new homes generally, not to generalize, but I think that is true. Institutional investors often like new product. It feels more like multifamily when you could look at a community of brand new homes, nicely landscaped, easy to maintain. Now, the yields tend to be a little bit lower, but the total returns, I think, relative to the risk are good. Lennar was one of the earliest groups to say, hey, we want to start selling homes to investors. So we helped. We put together a program where we could market some of the homes they were building, really targeting global investors for these homes, because our portfolio, our platform, Roofstock, is really built for people to buy homes sight unseen. And then we can connect them up with the right servicing if they want to rent them out, help them get financing, things like that. So having a completely digital platform is attractive to them. So that was the original idea, and it's borne itself out, that someone could be sitting anywhere in the world buying homes off of Roofstock, and some component of them are these new build Lennar homes, which are terrific and people love. So it's been I would say for home builders, kind of a once in a generation boom market. So it's not as if they necessarily need to do this right now to sell homes, but I think they and others are thinking longer term. How can we have multiple distribution channels and leverage platforms like Roofstock to be able to sell homes really efficiently?
Yeah, I think that idea of multiple distribution channels is something that the home builders hadn't really considered before, and now there's this whole new pathway. So I think it's interesting for those of us who are invested in home builder stocks. It makes us feel a little more confident about cycles, because cycles always happen.
Absolutely.
I know that you let investors easily sell their rental properties. So I'm wondering, are you seeing more demand, less demand in the wake of the pandemic? Are people trying to sell, or what's happening?
Well, again, that's the beauty of the marketplace. There's always buyers, always sellers. And I think for each individual has their own supply demand curve, so at some price, if you own a rental property, you're a seller, most likely. At today's price, you may or may not be. And so a lot of what we do is help work with investors or sellers who are thinking about selling their home. We have some algorithms, for example, that predict probability of sale at different prices. So if you have a home that's worth $200,000, or you think it is, we can help say, well, if you want to try to market it at that, it may trade, but it may take you 90 days. If you price it at 185, it'll sell in 5 days or 2 days or immediately. And so you're really allowing people to use a lot of those tools and analytics to kind of figure out at what point they're a seller. So I would say for the most part, we were, as a marketplace, probably a bit more supply challenge than demand challenge. No surprise. There's just a shortage of homes. There's almost limitless demand right now, but that changes over time. And so we're working really hard to open up more and more supply channels, both for individual investors to make sure people understand how they could market their homes through Roofstock, but also working with home builders, fix and flip groups who are producing homes that they could sell into the rental marketplace, going to finding direct relationships with owners. There's all sorts of different ways we are engaging to get more and more supply. And the iBuyers, we're talking, working with some of those guys just to get more of those channels going, because to have a successful marketplace, you need a diversity of product and diversity of supply channels. And I'd say over the last year, we've probably 10x'd the number of supply channels of suppliers who are coming into our marketplace, and we need to continue to do that to bring more and more supply that people can see on our marketplace.
Interesting that you're working with iBuyers, because I'm noticing that too, that iBuyers are now buying homes and then selling them back to some of the larger rental property portfolios. Do you feel like, to me, that looks like it's a growing trend that's only going to get bigger? What are you thinking about that one?
Listen, I think you've got investors who are looking at every channel they can to acquire properties. If they could acquire them directly, great. If they could acquire them through a marketplace like ours, great. If they could acquire them directly from iBuyers who are going direct to homeowners, great. The good news is for homeowners, there's lots more liquidity options for people or investors who want to sell. The advantage of a platform like ours, like Roofstock, is you don't have to vacate the home to sell it. So normally to sell homes, it's almost, I don't want to say always, but if you're going to sell it through the multiple listing service, selling it vacant is the traditional way to do it. Selling it with a tenant in place tends to be challenging. By contrast, we built our marketplace to offer homes with tenants in place, and we've turned that negative, we believe, into a positive, because you could step right into cash flow. We certify the home, the tenant, the local property managers. And so if you have a home that you want to sell that has a tenant in it, we're the most likely channel, because you don't have to vacate it and our costs are very low, and we have investors looking for homes with tenants. So there's lots of different opportunities, I think, for owners to get liquidity today, which is a benefit of having all this demand.
Absolutely. What are you thinking about potential changes to the 1031 exchange rules? Is that something that some of your property owners are concerned about?
Well, sure. I think that in general, it's been a very popular way for investors to build wealth in real estate over the long term. And I do have some concerns about it, potentially going away or getting limited. I just think uncertainty around things like that is generally bad for the market. And I think, and I know that the administration's studying this and looking at the impact. And my sense is, from my experience in it, an awful lot of the participants who take advantage of 1031 exchanges are small investors. It's not necessarily driven by a lot of large investors taking advantage of this. And I think when you look at that, for example, a lot of multifamily and single family rental transactions are, will use 1031 exchanges, and 98% of that market is owned by mom and pop landlords. At least on the single family rental side. It's more institutionalized on the multifamily side. But so I don't know that it's as productive at the end of the day when you look at eliminating something like that, whether it's going to end up penciling. So maybe there's some modifications to it, but I'm hopeful that it stays in some way, shape, or form, because I do think the real estate market does benefit from it, and the investors in it.
Yeah, I totally agree. Let's take a quick break here.
Like what you're hearing? Get more real estate investing news and advice from Millionacres on Instagram at Millionacres and on Twitter at Millionacres_co.
Hi, I'm Julian Hellman, CEO of Realty Mogul, a leading online marketplace to invest in high-quality commercial real estate. As many of you know, Million Acres has recommended several of our deals, and I wanted to share with you what makes the Realty Mogul platform unique. It starts with Realty Mogul being a values-driven organization. Our second most important value is to protect the investor. I want to share how we live and breathe this value at Realty Mogul. First, we have a standardized due diligence process. At Realty Mogul, we focus on the background of the sponsor, their track record, and dig deep on references. We also visit every site and understand the nuances of the location, local market conditions, and vet the pro forma numbers. But we do a lot more than that. We advocate at each step of the process for investor protection, and our dedicated asset management team supports each transaction through its life cycle. This ties in with another core value. Details matter. At Realty Mogul, we obsess, and I mean obsess, to get every detail right. And over the past 9 years, we've learned how important that is in driving successful outcomes. Last, although all investing comes with inherent risk, our number one value is to sleep well at night. At Realty Mogul, we do the right thing. Right by our sponsor, right by our investors, and right by our team. Call it karma, call it how we're wired. But as you evaluate opportunities on the platform, know that we want you to sleep well at night. Check out realtymogul.com, speak to our investor relations team, or drop me a line personally. Enjoy the rest of the podcast.
Not an offer to buy or sell securities. Investments not guaranteed.
I'm back with Gary Beasley of Roofstock, and we're talking about residential real estate investing. So I noticed on Roofstock you have this bring your own property feature that's in beta. I think this is a really compelling idea that you can find this property on your own, have it evaluated by Roofstock. What's the early response been on that?
It's been great. It's something that from the initial days we thought would be a cool feature to add. But we wanted to make sure we were ready for it, which we are now because we've been at it for 5 years and we feel like we're pretty good at underwriting in markets all over the country now with our algorithms. And so, yeah, the idea is we can only put so many homes on our site at any given time. There might be 500, 600, 700 homes for sale in markets around the country, but there's 90 million homes in America. So we're not going to be able to bring them all to our site. So if you find a property that you think might be interesting, we've created a way you can interface with us, enter in the address, and we will actually help underwrite it for you, and use all of our analytics and data, help you underwrite it as an investment property. And if you'd like, we could help you purchase that property. We could put you in touch with a local agent in the area who can be the representative and use our underwriting. And so people like it. They get some ability to not only take advantage of our platform and our ability to underwrite, but then they can get someone to help them through the transaction. So yeah, it's in beta. Demand's been really strong. We're getting more and more people every day bringing properties to us, and what's helpful too, it gives us data and it gives us insights into which markets are interesting, so we could expand our marketplace to areas where people are bringing us properties. We can go get like kinds of properties, like the homes that we're finding there, and bring them to the marketplace. So it is useful in kind of continuing to get this flywheel going and create more and more network effects around with these owners and these types of properties.
Interesting. So with the agent situation, are those referrals, or is Roofstock licensed as a brokerage in certain areas? How does that work?
We are. Yeah, we're licensed as a brokerage. So think about us. It's a bit like Uber. Uber is, no one thinks about Uber as a taxi company, but they follow a lot of the regulations of that. It's the same with us. I mean, we're a licensed brokerage, and so that's how we get compensated. But we're a marketplace that sits on top of that, and so we can get referral fees and things like that. And on the sell side, we do represent on the listings that we have on our site where we're the listing agent. We represent the sellers.
So part of that program, it seems like Roofstock is kind of growing in terms of artificial intelligence, machine learning, because you've got all this data flowing in and you're constantly kind of tweaking that platform. How is that helping you scale, and what are you seeing as far as how is it kind of helping become more accurate?
Well, we knew when we started Roofstock, data was going to be critical to our success. It's one of the things that I think real estate in general it's much better now because there's been so much investment in prop tech over the last three plus years. Prop tech didn't exist as a word when we started Roofstock. It just didn't. It wasn't a thing. Now it's a thing. But we knew we had to hire some data scientists. We didn't know what we were going to do with the data. We knew that if we could map the whole country and map every home, knew who owned them, what the homes are worth, what the rents are if they're rentals, what the rent should be, if it could be a rental property, if it would be a rental property, and how to contact those owners, that would have value. So we did that. And so we called that the Rental Genome Project. We mapped every home in America. That data is an incredibly rich data set. And then we also created neighborhood scoring system. So every neighborhood has a ranking that looks at things like school quality, crime statistics, employment, percentage of owner occupants, all that kind of stuff. And it allows us now to look at homes and neighborhoods as investments in a really granular way. And then we have a lot of data that we have purchased, data that we could that's publicly available that we could scrape, and then we have some proprietary data. We layer all that in, and so that allows us to build models that predict value, I think more accurately, arguably, than others, because we're factoring in lots and lots of stuff. We're predicting where we think things will trade, and then we learn from that. The machine learns and says, okay, we thought this was going to trade at 200,000. It traded at 220. Why is that? Oh, that's interesting. It seems like everything that is a block or less away from a park tends to trade more than the algorithm thinks. So let's trade. So the algorithm learns these things, and we've developed things like characteristics that are positive or negative to the value of an exact home location. Things like power lines are negative. Things like being near a park is a positive. Things like being close to a school are positive, but if you're right across the street from a school, it's a negative. And so think about there's a half a dozen or more on each side, and the machine learns from these things. And it's hard for an appraiser to just look at comps. It's not a fair fight if an appraiser is sort of saying, oh, this is in the same neighborhood, I think it's kind of about this, versus us looking at all these things, and it's not as if every individual is factoring in these things so precisely, but at the end of the day, humans are pretty good at assessing a lot of complexity and building that into what they think something is worth to them. And so we're trying to help the machines get to something similar.
Fascinating. Let's talk a little bit about property management, because I think that's the difference between, being a happy real estate investor and being one that just really wants to get out. So how do you vet the property managers that you have inside your network?
We knew when we started Roofstock that last mile of servicing was going to be so critical, because it's one thing to buy a home and it's another thing to manage it, to operate it. And so we started with the idea that we would certify local property managers who are, and we still do this, and we work with over 70 of them around the country. We look at their footprint, their track record, how long they've been in business, what kind of accounting system they work with, customer reviews, all these things, and we pick typically 2 or 3 in each market, so there's some choice for people. And then we connect people, investors who are buying through our platform. We make these available, and you could choose your property manager at checkout. And that's worked really well. We get a lot of client feedback also on property managers. And to the extent they don't do a good job, we replace them with those who will. And so, and by doing that, we're able to give a lot of business to a smaller number of firms, and we get good pricing for the clients who are using them. So we can negotiate institutional pricing, because we may be giving property managers hundreds of contracts rather than just you, Deidre, going and say, hey, I'd like you to manage my property. And they might say, okay, that's 10% of rent plus. We're coming through Roofstock, it might be 7. So we bring kind of one of the themes of Roofstock generally is taking some of the benefits normally available to large institutions, whether it's analytics, financing, pricing on things like property management, and make it available to the masses, and really sort of democratize access. So you don't have the scale of a big institution, but we can get you a lot of those benefits is really part of the real vision.
one thing I think is interesting about Roofstock is you work with those individual investors, but you also work with institutional investors, right?
We do.
And so how does that kind of work? Are you seeing more institutional investors getting in the space? Surely they're seeing the headlines too and wanting to get in on this.
Yeah, I would say the good news is we're seeing increase in both segments, and I would say it's funny. We bucked conventional wisdom, I would say, by fully embracing both retail and institutional segments as really critical segments to our business. Oftentimes, the advice to founders is pick your customer, have a very, very focused, view of who your customer is, and just relentlessly build to that customer. We thought about doing that, but then we said we couldn't figure out which customer we liked better, and we said, you know what? It probably means they're both really important to us. And so why don't we build a single platform that could service multiple clients, large and small, but use the same infrastructure, the same data models, everything. And because we're getting data from a lot of the big institutional deals that we work on, and then we have the data from all the 90 million homes that we own, or that we have mapped, which is 98% mom and pop owned. And both of those segments are critical. So for us, I would say, while they've both been growing, the institutional side demand has grown much faster than I would have thought in the last 6 months coming out of COVID, because of these reasons we talked about before. And so we've built, about 2 years ago, we started building a platform we call Investment Services, specifically designed to bring new institutional investors into single family rental, and they could rent our platform basically. So think about us as sort of the real estate investment cloud. It's almost like AWS for real estate investing. So rather than hiring 600 people and building an Invitation Homes or a Starwood Waypoint, you can rent ours and just pay us as you go to build the portfolios, and then we can manage them for you. And so we do have our own property management company that today is focused exclusively on investors of scale. So large institutional investors, we will manage homes for them. At least for now, we're not managing for retail investors. And so that business, I could say, demand is off the charts. And I would say our volumes have grown about 5x from January to June in terms of the amount of capital that we're deploying in that segment. And I anticipate that's going to continue to grow over the next few years based on the demand. But for us, it's nice because it allows us to just use our platform, make our platform work harder, but in all the transactions that we're involved in, help us, overall across the business. So that's why we've chosen to embrace both the retail and institutional.
Interesting. So with those institutional investors, do they select the properties, or do you select the properties? And do you have different theories for each? Like, do you build like a Sunbelt portfolio or maybe a sort of more diversified portfolio?
Yeah, the nice thing about it from an investor standpoint is they kind of get the best of both worlds. They design with us the buy box that they want. We'll do research on markets. They'll come to us typically with an investment thesis and say, we want to build a $500 million portfolio with say a 5% net yield at average, and this is the total return we're looking for, and we want to be in good neighborhoods. Yeah, that's very typical. We want, so we want a ton of volatility or whatever. Okay, so we could go through and we could come back and map that stuff and recommend markets, and they may have specific markets or not. And then we design a buy box mutually. And then once those buy boxes get set, we could go out and make the trades for them. And then we have weekly check-ins, and we have a dashboard so they could see what we're buying, and they could adjust their parameters. They could stop buying at any time. They could add markets. And they get real-time feedback, and we're constantly adjusting the dials on the underwriting. If they're buying too slowly or too rapidly, they can make those adjustments. So they have a fair degree of control over how things are going, but it's super easy for them because we're doing all the work. And so that's why I'd say it's kind of the best of both worlds for them. There could be, say, one person at a PM at a private equity fund or a sovereign or a pension fund interfacing with us and building a portfolio that could look very much like one of the large REITs. It's just everything's outsourced through Roofstock.
Interesting. And with these, are they They're obviously buy and hold. How long are they holding usually?
I think for the most part, it depends on the investor, right? If it's a large family office or a sovereign, they might be looking to own these things, or an insurance company, they might be looking to own these things indefinitely. When you think about the REITs, right, they're holding these things indefinitely. If it's a fund, let's say it's a private equity fund that has a life, typically a 5 to 7 year investment horizon. And so I think in those cases, they would look to build the portfolio over, a 2 to 3 year period, and then grow it and then sell it at the end, in a 5 year to 7 year horizon. So I'd say the investors who are building portfolios today, for the most part, are building it for at least the medium to long term hold. And I think that's pretty universal. And some are looking to hold even longer than that horizon.
Let's talk a little bit about last year's migration trends. It seemed like everybody was moving to Austin. The Sun Belt boom was happening before COVID, but seems to be growing even more. What are you seeing in terms of buying and selling that may indicate some of the migration trends?
Well, we have seen migration out of large cities into secondary markets, suburban markets around big cities, secondary and tertiary cities. And it's been fascinating to see, and that's both for homeowners and investors. I think the classic is, someone's working on Wall Street as an associate or an analyst, has to work from home, has 3 roommates in Manhattan, moves back to Pittsburgh. Maybe he or she's living with their parents and says, wow, I could buy a home in Pittsburgh. Maybe I'm going to buy a home in Pittsburgh and stay, or lease a home in Pittsburgh. I could do my job. And that's happening, tens and tens of thousands of times. And so I do sense that I personally believe there will be a renaissance in a lot of these cities, and there will be a return of a lot of folks. And I think people are missing the vibrancy of cities, but I think there's still plenty of demand in a lot of these other markets. And so I think you've seen a lot of resort markets boom, places like Lake Tahoe. In the last year, you've gone from a whole bunch of listings to none, and that's happening in resort markets all over. Will that stay as robust? I'm not sure it will. I think people who are working from there may eventually want to be closer to where they live when their offices reopen, right? So, in fascinating dynamics. It's one of the things I love about real estate is it is always changing, and it's hard to know exactly how it's going to play out. But I think you will see some people just permanently choosing to be in lower cost cities. I think you've seen a migration to low tax states. Low tax states are not only attractive for individuals, they're attractive to companies. And so you've seen a number of companies moving out of some of the higher tax states, like where I am in California, to lower tax states like Texas or Nevada, Arizona, Florida. I personally am still bullish on California because I think it's hard to bet against California, and I'm a little biased because I live here. But it's not for everybody, and there will be. I think it's healthy for the state, for example, to see companies leaving, realizing that maybe we're overtaxing, maybe we're overspending, and I know the governor's office is sort of getting a lot of this stuff now and wants to be competitive. So it's the free market at work. So let's see what California does to remain competitive and encourage businesses to stay or to come here. So I think it's healthy.
Yeah, I think I share your fascination with watching things change. You shouted out Pittsburgh. Pittsburgh is a market I'm kind of watching. Are there any markets like that you think people are sleeping on? I've been watching Columbus and Cincinnati also. I feel like some of the Midwest markets are.
Are you from the Midwest? Is that what draws you to those places?
I'm not at all. I'm from Boston, and I just moved from California. So but I'm seeing this sort of interest in the Midwest happening, and partly just because the prices are so low. What are you seeing? What do you think people might be sleeping on?
Yeah, all those markets you name are very interesting and are active on our site. I mean, you'd be surprised. Places in like Birmingham, Alabama, which were not really on anyone's radar, super popular. Places that have I would say, an affordable entry point, nice yield, and good employment prospects like that. So look to where there might be factories being built, or places like that. It doesn't take much to really lift up an area if there's going to be a plant that comes in, and so the nice thing is I think you're seeing growth really distributed. It's just not in one or two places, but there's dozens and dozens of cities like that. It's one of the things I think people like about Roofstock is you could go on and do research. You find homes that might meet your criteria in a place you hadn't really thought about, and then you could do some independent research on, do I like Birmingham? What do I like about it? Yes or no, and you could find similar type houses and similar type markets. And we try to provide a lot of information, but it's also for many kind of a launching off point where you say, okay, now I've discovered 6 other markets I think are cool. I'm going to do some independent research, and then come back and perhaps buy something or put together a portfolio of homes that otherwise you wouldn't have even thought about. I think one of the unique things about about Roofstock is a lot of times people come thinking they want one thing. Like, I think I want to buy a home in the Bay Area, and they'll say, wow, you don't have really much for sale there, but boy, there's some really interesting homes in some of these other places. Just a quick aside. I was on a flight a couple of years ago. The guy next to me ended up looking at my computer, seeing Roofstock. What's this? I said, oh, it's Roofstock. He bought a home on the flight.
Wow.
He had been he bought a home in Atlanta on the flight, online, chatting with one of our advisors. He couldn't believe he could buy a home for $128,000 in Atlanta. He'd been trying to buy a investment home in the Bay Area for 18 months, and he did it during a 4-hour flight on Roofstock. So that's the kind of stuff that is really cool. He had never thought about buying a home in Atlanta. He's like, what would I do about management? I said, here's the certified property managers in that area. You could select which one you want. So it does open up the whole country, and I think arguably allows people to have a much more diversified portfolio. If you kind of know what you're looking for, I think it's one of the things we love doing. We think it just helps people be better investors.
Well, I think that idea of just being able to kind of click and buy to some extent is where so much of the industry is going. What is the average transaction length on your site? Are most people cash buyers, or is there financing involved? What's that like?
Most people are using financing who are buying on our retail site. So our institutional buyers obviously are cash. They have separate credit facilities. They buy for cash. And they do buy some homes off of our marketplace for sure. But the majority of our retail buyers are buying using Fannie and Freddie loans. And so you can borrow typically up to 80%. So you can't borrow as high as you might be able to in an owner-occupied loan in certain cases, but you borrow up to 80% at very attractive rates. And I believe with Fannie, you could still do up to 10 loans. And I think with Freddie's program, it's 6. So for most individuals, there's plenty of capacity. And then if you want to set up an LLC, there's groups like CoreVest and others who will loan to the LLCs. So, but yeah, the majority of buyers are using financing, and it works. It works fine. It works well. So I think, unlike in the owner-occupied market, where I think you're seeing many homes trading for cash, and people sort of be getting frustrated, increasingly getting shut out. Still, the majority of our folks are using financing.
Excellent. All right, last question for you. You've been involved in so many aspects of real estate, brokerages, institutional investing, what you're doing now. What do you think the future holds? And also, why are you still in real estate investing? What lights you up about it?
Yeah, so well, I love building things, and this in real estate, as we talked about earlier, is residential real estate's the largest asset class in the country. It's so diverse. There's so many different things happening, and it hadn't changed a lot in 100 years, the way homes transact, right? So what we're trying to do is bring a lot more efficiency, make it much easier for folks to access it. What I'm excited about is continuing to see some of the trends that are starting now progress. For example, we're about to relaunch our Roofstock One fractional product. And I hate to use the word fractional because people might think it's timeshare. It's not timeshare. What it is you could buy shares of homes and get exposure for less money, or you could buy slivers of homes. If you have $10,000 or $20,000, buy slivers of many homes rather than one. So things like owning pieces of homes, fractional ownership, secondary exchange, perhaps for these shares. So really, truly making real estate trades more liquid, which is the vision behind Roofstock, is how do we make real estate trade like stocks, right? Low friction, rapid, high level of transparency. And so Roofstock One is one construct that we've come up with, which we think can approach that Amazon one click of real estate purchases and sales. So that's what I get excited about. Is it's products and services that are not only good for us, but more importantly, good for customers. And just listening to customers, what do you want? And then how can we figure out how to apply technology, better business practices, all this kind of cool stuff, machine learning, all that's kind of below the surface. People don't really care. All they know is, I'd like to buy or sell a home or a piece of a home with low or no friction. Boom. And that's what we're working on. And I think that's where we're going. And I think we'll get there. And I think it's an exciting time to be working on things like this.
Okay, now I have to ask you about fractional. I know I said that was the last one, but fractional is something I'm fascinated by right now. We've seen a couple of different startups starting to do fractional again. Why did you stop Roofstock One, and why are you ramping it back up now?
Yeah. So we always knew that the first Roofstock One was our beta. We wanted to try it out and see if there was product market fit. We did it in a Delaware statutory trust structure, which we knew was sort of bulletproof, but wasn't particularly scalable just because of the administrative burden. People didn't like getting K1s, for example, versus 1099s. So we said, that's okay. We did it with 70 homes, and we tried it out, sold out all the shares. We're like, okay, cool. People love this product. How do we think about a more scalable approach to it? And so we have come up with I think a radically different approach to how we're doing it. And we're not ready to announce yet exactly how we're doing it, but we will over upcoming months. And we believe we've created a structure that will be the category killer, that will allow people to invest in shares of homes in markets they like really efficiently. So stay tuned, I would say, for that.
Okay, I am officially fascinated. Well, thank you so much for your time today. Reminder to listeners, you can always learn more at roofstock.com. You can always email us with questions, comments, media@millionacres.com. Stay well and stay invested.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. If you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discussed at Million Acres, or the Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.